Trading more often makes you poorer. That is the uncomfortable truth from 3 decades of investor data. The average retail investor lags the market by nearly 3 percentage points a year, and the most frequent traders lose even more. DALBAR, a financial research firm, tracked investor behavior for 3 decades, from 1992 to 2022. Over that period, the S&P 500 compounded at 9.65% annually. But the average equity fund investor earned only 6.81% per year. That is a gap of 2.84 percentage points every year. Over 30 years, that difference compounds into a massive shortfall. It is not a small leak, it is a hole in your returns. In a landmark study, finance professors Barber and Odean analyzed over 66,000 retail brokerage accounts. They found that the most active traders, those in the top 20% by trading frequency, underperformed the market by 6.5 percentage points per year. Even more striking, 5.3 of those points were eaten up by trading costs alone. That means their strategy, before costs, was not terrible, the costs themselves were the killer. A 2025 report from the Shenzhen Stock Exchange paints an even starker picture. It breaks down retail investors by monthly trading frequency. Those who traded 0 to 3 times a month earned a cumulative profit of 18.7% over 5 years. Traders at 10 to 30 trades per month lost 12.5%. And the hyperactive day traders, with over 30 trades a month, lost 34.8% over the same period. The more you trade, the worse you do, a perfect staircase downward. Let's formalize the problem. Your net return is your gross return minus all costs. Trading costs include commissions, bid-ask spreads, and market impact. If your gross return is 10% but you pay 1% in costs, your net return is 9%. Over time, this drag compounds, so the impact is much larger than it seems. How good do you have to be to overcome costs? Suppose your average winning trade makes 1% and your average losing trade loses 1%. With a round-trip cost of 0.5%, your break-even win rate is 50% plus half the cost per trade. That is 50.25%. It sounds easy, but the cost is per trade, and frequent trading multiplies it. With 100 trades a year, you need a much higher win rate just to break even. The real damage comes from compounding. Over n trades, your terminal wealth is your initial wealth times the product of 1 plus net return per trade. Even a small negative edge per trade, repeated hundreds of times, can wipe out your account. This is why overtrading is not just a minor drag, it is a guarantee of ruin over time. The data consistently shows that passive strategies beat active trading for most investors. An index fund that tracks the S&P 500 has near zero costs and requires no timing skill. Active trading, on the other hand, incurs costs and relies on an edge that most traders do not have. The comparison is stark. This chart shows the cumulative 5-year returns from the Shenzhen Stock Exchange report. The leftmost bar shows a positive 18.7% for low-frequency traders. The middle bar drops to negative 12.5% for medium-frequency traders. The rightmost bar plunges to negative 34.8% for high-frequency traders. The pattern is unmistakable. Let's put the key numbers on the table. The annual gap between the S&P 500 and the average investor is 2.84 percentage points. The most active traders lose 6.5 points per year versus the market. And hyperactive traders can lose over a third of their wealth in 5 years. These are not trivial differences, they are life-changing shortfalls. Why do we keep overtrading despite the evidence? Behavioral biases play a huge role. Overconfidence makes us believe we can beat the market. Loss aversion pushes us to sell winners too early and hold losers too long. The illusion of control makes us think we can time the market. And the feedback from occasional wins reinforces the habit. Understanding these biases is the first step to overcoming them. What can you do about it? First, measure your own performance honestly, including all costs. Second, set a trading budget. Limit the number of trades you make per month. Third, prefer low-cost index funds for the core of your portfolio. Fourth, if you must trade, use a checklist and stick to it. Discipline is not boring, it is the edge that most traders lack. The evidence is overwhelming, trading more often leads to earning less. The data from DALBAR, Barber Odean, and the Shenzhen Stock Exchange all point in the same direction. The math of transaction costs and compounding turns a small drag into a guaranteed long-term loss. The most profitable strategy for most investors is to trade less, diversify, and stay invested. We would love to hear your thoughts on how you manage your own trading discipline. Thanks for watching. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.